Imagine one of the biggest, most powerful companies in the world, a true giant. Now, picture it getting absolutely slammed in a financial firestorm, losing billions of dollars in just one day. But here's the crazy part, the thing that set it all off. It's not what anyone expected. We're going to break down exactly what went down with the Adani Group, how it all happened, and why it really matters.
So let's start with this number, $12.5 billion. That's how much value just poof, vanished from the Adani Group's market cap in a single trading day. A number that big just begs one simple question: how?
And yeah, that really is the central mystery here. What on earth could possibly cause that kind of massive, sudden implosion of confidence? You'd think some huge breaking scandal must have dropped, right? But the truth is actually way more subtle, and honestly, a lot more interesting.
So was it a brand new bombshell report, some kind of catastrophic fraud suddenly brought to light? I mean, the market for sure reacted like it was. But the real trigger? It was something way quieter, almost hidden away in the boring procedural details of a legal fight that was already happening.
You see, the panic wasn't triggered by a new crime or a new allegation. It was triggered by an email. Or to be more precise, the request to be allowed to serve a legal summons through email. And that one tiny procedural move by U.S. regulators, it became the spark that lit a multi-billion-dollar bonfire.
Okay, so this timeline really shows you how the pressure was slowly building up. It all starts back in 2024 with an indictment. Then, U.S. regulators try to go through the official channels to serve a summons, but they get blocked, not once, but twice. So finally, in January of 2026, they go to a U.S. court and basically say, look, can you just let us email it to them? And that was the moment the market just freaked out, thinking the legal net was finally for real closing in.
This whole panic is a perfect textbook example of a concept called keyman risk. The market didn't see that email request as just a boring procedural step. No, they saw it as a direct threat to the group's chairman. The fear wasn't about one bad contract or a single fine. It was that the leader of the entire empire was being cornered. And without him, well, the whole thing suddenly looked incredibly fragile.
So here's the really crucial part. This fear, which was initially tied to one very specific legal case, it didn't stay put. It spread like a virus across every single listed company in the Adani Group, kicking off this huge, indiscriminate sell-off. And just look at the damage on that single day. It was brutal, and it was everywhere. Adani Green, which was the company right at the center of the allegations, got hammered, down over 13%. But look, so did Adani Ports and Adani Power, completely different businesses, also dragged deep into the red. You're watching financial contagion play out in real time.
Let's just put this into perspective. You had Adani Green, which was the epicenter of this legal earthquake. But then you have Adani Power, a thermal power company, a totally separate business, getting pulled down right along with it. Investors weren't selling because of performance, they were just selling the name.
All this chaos really sets up a classic Wall Street battle. On one side, you have the company's actual numbers, its fundamentals, and what it's telling everybody. And on the other side, you've got the raw, powerful emotion of market fear. And for a few days there in January, let me tell you, fear was winning, big time.
So the Adani Group came out and tried to put out the fire. They released a statement saying, hey, everybody calm down. This is just about how a letter gets delivered. It's a procedural thing, not a new problem. You know, our ports are still running, our power plants are still making electricity, it's business as usual. But the market, yeah, they weren't buying it. What investors heard when the U.S. regulators made that move was that the bureaucratic shield that seemed to be protecting the company's leadership was now gone. They thought, okay, the U.S. is finding a way around the roadblocks, and that meant the real risk just shot up dramatically. So all of this creates a fascinating dilemma for any investor, right? When you see a sea of red on your screen and just widespread panic, is that a signal to run for the hills? Or is it maybe a sign that a really great company might have just gone on sale? Let's just zoom in on Adani Power for a second. As an example, if you look at its return on equity, which is just a key way to measure how profitable a company is, the story is pretty clear. At 26%, it's making more than double the profit for every dollar invested compared to its biggest rivals. Fundamentally, this thing is a highly efficient, cash-generating machine.
And that right there frames the two arguments perfectly. The bulls, they see a classic buying opportunity. A fantastic company getting unfairly beaten down by fear and scary headlines. But the bears?
They argue that none of that profitability matters if sanctions come down and cripple the leadership's ability to run the business. In that world, the great fundamentals become totally irrelevant.
So, where does the story go from here? Well, there are two immediate things you gotta watch. First, what does that U.S. judge decide about the email summons? That is going to set the legal clock ticking. And second, the next quarterly earnings report. Can a huge flood of cash from strong results finally wash away all this market fear?
Which leaves us with this final critical question. We all know that over the long run, a company's value is supposed to be tied to its performance, to its fundamentals. But in a short-term crisis that's driven by pure sentiment and fear, can strong fundamentals actually protect you? Or, in the end, does fear always win? That is the multi-billion-dollar question investors are still trying to figure out today.